Like most things in life, achieving your goals requires planning. Whether it's organizing your summer holidays, building your family home, or even baking a cake, your groundwork sets you up for success. Attaining your financial goals is no different. Building a robust investment portfolio requires thought and planning. Stick around to the end if you want to find out how you can also review an existing portfolio and how to keep it in check. Let's start with a basic question. What exactly is portfolio construction? Portfolio construction is the process of combining different asset classes and individual investments in a way that appropriately balances risk and return, with the objective of achieving your financial goals over a defined time horizon. Part of the process is determining your allocation to growth versus defensive assets. Have a look at this graph. Your portfolio can be constructed from any number of these asset classes. These include stable investments like cash and bonds, to more volatile investments like shares and infrastructure. In general, the more expected risk you take in an investment, the greater the potential return. Here are 5 key questions to ask yourself when building a portfolio. Number 1, where should I allocate my funds? Your asset allocation is probably the most important decision you will make. According to Roger Ibbotson and Paul Kaplan, asset allocation explains about 90% of the variability of investments' returns over time. How much you invest in Australian or global shares, bonds, or property will depend on your risk profile. How much risk you can tolerate will depend on your age, stage of life, temperament, and a number of other factors. You can complete a risk profile test that will help decide how much to allocate to different asset classes. Number 2, how much will these investments cost? Your investments management fee, MER, and implementation costs, brokerage, are both important considerations. Given that investment costs will differ across active and passive investments, it is worth considering how much you should allocate in each bucket. Number 3, how much risk do you want to take? Another consideration when deciding active versus passive is how much to allocate within a specific asset class. For example, Australian equities is a very broad asset class. You can get access to Australian equities via active managed funds or index-based ETFs, and they will inherently carry different risks. An actively managed fund in Australian small caps is likely to have higher volatility compared to a passive ETF that tracks the largest Australian companies. With that in mind, having a portfolio 100% in small cap investments compared to a portfolio that uses market cap ETFs will have significantly different risk and volatility. Number 4, what ingredients will you use to implement your portfolio? The benefits and risks associated with each investment choice differ, so it is important to choose wisely. Direct shares give you direct ownership of a part of a company, which involves stock-specific risk, for example. Managed funds, money is pooled together from multiple investors and then invested into a portfolio of assets such as stocks or bonds. Traditionally, investors buy units in a managed fund by making an application to the fund manager. ETFs, a special type of managed fund that can be traded on an exchange like the ASX. Because you don't have to apply for units, there is less administration involved in buying an ETF when compared to a managed fund. ETFs generally offer better liquidity, access to capital, and greater holdings transparency compared to managed funds. Number 5, how often should I review my investments? As you would when you're building a home or baking a cake, you will want to check in every so often to make sure your portfolio is moving in the right direction. It is important to have rules in place on how often you review or rebalance your portfolio. For example, you might decide to rebalance annually or quarterly. Rebalancing generally involves looking at your asset allocation to see if it remains in line with the goals you set for yourself at your previous rebalance, and taking steps to adjust your investment if required. Those are 5 things to look for when building your portfolio. Having a strong foundation and framework is essential to building a solid portfolio that can weather the different seasons of market volatility. If you haven't already considered it, it's worth using ETFs as a building block for your portfolio. The global ETF market has experienced astounding growth over the last 5 years and has more than doubled from $4.69 trillion in 2017 to over $9.55 trillion in 2022. Due to ETFs being low-cost, transparent, and easily accessible, we are seeing ETFs making up a growing share of portfolios for both individual to sophisticated investors. Check out our website here for some investment ideas. Thanks for watching.